everybody. Happy Monday. Welcome to a new start of the week. My name is Julius de Kempenaer and I'm going to talk about sectors, sector rotations, RRGs, anything related to that. Before we start the show, let me once again point out that my email address is available. Just check out my blogs. It's all over the place. If you have any questions on RRGs, on relative rotation graphs, on my approach, if you have any comments, even if you don't agree with me, I'd love to hear it. I always appreciate a good discussion, and I'm certainly not in the opinion that I'm always right. So if you feel that what I'm telling you makes no sense at all, also let me know. Anyway, as I said, happy Monday. Lots going on. I think that last week was an interesting week because when we started the week, it was really like technology, large cap, FANG stocks driving the market. And all of that changed in the second half of the week, I'm going to say. And we've been talking about the narrowing breadth and all that for quite some time already in this program. And for this week, what I want to do is take a look at the growth value rotation and then combine that with size rotation, dive into sector rotation, and if we have a little bit of time left, maybe even look at some individual stocks, but not sure whether we're going to make that. The first RRG, first relative rotation graph that I want to share with you is the one that shows growth and value rotation. Now you know that I prefer the weekly time frame. So let's start with the weekly time frame. And here you see growth and value stocks. It's very clear that this is a very strong preference for growth stocks still on this weekly time frame. But let's see how this changes when we zoom in. So when we go to the daily time frame, you can see how this all of a sudden has turned around, especially in the last 2-3 days of last week. You can see how growth has now rolled over, while value, on the other hand, is curling back up. Now, it's not a change of trend yet, but mind you, we're in this massive steep trend in favor of growth over value for quite some time. And even with the long-term trend still very much in favor of growth, I wouldn't be surprised if we need to see some sort of a cool down, some sort of a digestion, a pause in that trend. And whether such a pause or a sideways move or a digestion after a rally is going to completely turn around the trend, I don't know. It's way too early yet to tell. But it is important to acknowledge that we've seen that narrowing breadth, and now we're seeing that rollover of growth versus value. So I want to zoom in a little bit on that. As I said, here's the growth value rotation. This is the daily growth value rotation. And you can see how markets are now starting to rotate out of growth and into value. It's very early. Growth still on the right-hand side, value still on the left-hand side, but please be aware of it. Now, the second RRG that I want to share is let's say the extended version of the previous one. We're still looking at growth versus value. But here we also see growth and value broken down in the various size segments, so large cap, mid cap, and small cap. So let me massage this chart a little bit for you. So by the way, the way I get to this chart is it's a predefined group on the RRG page. You go to select, in the drop down you will find growth value, that's the first one. Size only looks at sizes, and here is growth value and size. And that will look at the growth value broken down in size segments. Starts with the weekly version. I already brought that to the daily version for you. And what I'm going to do now is basically bring it down to the 6 real elements. So large cap growth growth is just the growth part, so I'm going to take that out. Then we have large cap index, that's just the large cap index, we're going to take that out. The Dow Jones US index is the benchmark right here, I have it double there. And then we have mid cap growth, we have small cap value, we have the small cap index, we're going to take out the small cap index. We have mid cap value, then we have the US value index, we're going to take that one out. We have the small cap growth index, and then we have the Dow Jones US mid cap index, we're going to take that out. And we have the large cap value index, and you'll see that it leaves us with 3. So it's growth and value broken down in large, mid, and small cap segments. Now look at this RRG. It is very lonely for large cap growth inside the leading quadrant. It's been like that for quite some time. If we scroll down, scroll back this chart, then you can see how large cap growth started to pick up. So here is large cap growth. That's the blue one right there. Let me highlight this one here. So large cap growth picked up, another rotation. We're now in May, and it goes back and it shoots off into the leading quadrant in May, makes a little curl, rotates back up. And then that last bit, so we're now in June, at the start of June, after this little blip here, basically starting somewhere mid-May, where large cap growth dominance started to really show. And you know that these little V-shaped moves, it looks as if it's counterclockwise, but in reality it's a clockwise move. But it's so fast that it is not even showing on that daily. So if we would have an intraday RRG, like a 60 or a 30 minute of this ticker, we would actually see a clockwise rotation right around that hook point right there. So it shoots up, and you can see how the nodes are increasing. So it's a really powerful move. But it is the only segment in the US market that is really moving up at that time. And then last week, so this is the 18th, and then 19th was a holiday. So we started rollover on 20, 21, and this is today, the 24th, on Monday. And you can see how the disconnect between large cap growth and all the other segments is still there, and it's starting to roll out. And the thing is that even mid-cap growth and small-cap growth are picking up. So across the board, you now see the money moving out of large-cap growth into the other segments. In a way, it's good news because it means that the market is broadening out. But we'll start looking at market cap influences, and you will see that large cap growth is a very big part of the market capitalization of the S&P 500. So the real question that we need to ask ourselves is, if large cap growth is going to rotate out and hit weakening and start to digest and move sideways or maybe even move down, will the move of that money into these other segments, and we'll look at the sectors in a minute, be enough to keep the S&P, or in this case the US Dow Jones US index, at those high levels, or will it start to pull down the index? I think that is the big question that we need to be aware of. We definitely need to be aware of the fact that large cap growth is under pressure right now, and we can see how that money is starting to move into other areas of the market. Pretty much every other segment under the sun in this 6 symbol universe. Here's the RRG for sectors on the daily time frame, and again you can see the disconnect between technology and pretty much all other sectors on the other hand. So there's only one sector on the right hand side, which means there's only one sector in a relative uptrend versus the S&P 500, and that's the technology sector. Again, it is starting to roll out what we just saw on that growth value RRG as well. On the other hand, we will see consumer discretionary moving sideways in there. And the other ones have all started to curl back up. Pretty much all these sectors have started to curl up. Now, what I just mentioned on the market capitalization for large cap growth versus the other segments also goes in this universe of sectors, because technology is the largest, followed by consumer discretionary, and together they form a big chunk of the market. And as I said, it is what we really need to think about and worry about or be aware of is how is this technology is already rolling over. You can see how consumer discretionary is actually on a very short tail and not picking up any momentum anymore. So this one, I would say, is at risk of rolling over before it hits the leading quadrant. So keep an eye on that one. And all the other ones are starting to move right up. So the bigger ones here are healthcare and financials probably. All the other ones are relatively small, and that's why they're all clustering onto that lower left-hand corner to offset the move of the technology sector. As you know, this is a closed universe, and that means that all elements on the canvas are in the S&P 500 or in the benchmark. So by default, it needs to be evenly spread out, and it's influenced by market capitalization. So if you would drag a vector from the center of the chart to the latest point of every sector and weight that move by market capitalization, you would end up with 0. And that's why it's a closed universe, and that's why it has to be balanced out. Again, technology rolling over, consumer discretionary stable, all the others are starting to pick up. Now, I don't do this very often. I don't go into intraday stuff in this show because it's a weekly show. If I stick in intraday charts, they're old within whatever the time frame is, so within probably the hour. But I'm going to do it anyway because I think that what we see on that intraday chart, and by the way, it's a good excuse to show you that we actually do have intraday RRGs available on the platform, and they make sense. So let's bring this universe of US sectors to the 60-minute time frame, and look what we've got here. This does not happen very often. As a matter of fact, I don't think I've ever seen it. What you see here is technology shooting off into the lagging quadrant. By the way, the market just closed on Monday the 24th. We're time stamping at the start of the hour, so this is the last bar of the hour of the day, and technology is shooting off into the lagging quadrant, and all these others are clustering inside the leading quadrant. Remember what I told you about the balance and the closed universe on that daily chart? Exactly the same happens here on that hourly chart. If you would bring all the vectors in from the endpoints to the center of the chart and weigh them by market capitalization, you would end up by 0. So technology tanking, all the other ones are keeping up. And what you see is that the S&P 500 just closed down 30 basis points, NASDAQ a little over %, and the Dow is slightly up. So the S&P is now starting to digest, to lose, and you see why that's happening. If we go over the individual tails here, and let me rank them by percentage change. So this is the percentage change over 5 periods, so that's 5 hours. Let's make that 6, so we've got pretty much the entire trading day. That's minus 50 basis points for the S&P. Yeah, right, so we got one and a half hour of yesterday, so that's pretty close enough. And what you see is that technology is responsible for 1.5% of the decline. Consumer discretionary is responsible for 90 bips of the decline, and then it's the S&P over the 6-hour period. Now we got minus 50, they're all above, and then only from financials upward, all the way up to energy, which is up 0.9. And still, with these ups, it's dragged down 30 to 50 basis points because of the heavyweights discretionary and technology, dragging that market down. Now let's take a look at the tails and how they move. So here's energy. That's, you know, a positive tail, strong direction, strong RRG heading. Same goes for utilities. Same goes for staples. Healthcare, kind of sideways, digesting. Real estate, same. Financials, positive tail. Materials, positive tail. Communication services, losing momentum, slowing down here, but losing momentum. Industrials, really good. And then consumer discretionary, and then obviously technology. So with only two seriously negative tails, basically really only one in the negative heading, and then discretionary rapidly following, we're already seeing that decline in the S&P 500. So this is kind of underscoring that narrow base of the technology sector and those large cap stocks, which are now starting to rotate out of favor, and it immediately stops the rally on the S&P 500. So as I said, the question is really whether all of this will be strong enough to keep the S&P at current levels. If you look at the, this is a great dashboard that we have, the market factors. This is basically the market grouping of the RRG that we just had with the large, mid, and small cap value and growth segments. The core segments would be the large cap, the mid cap, and the small cap groups. And what you see here, they're all green except for large cap growth and large caps in general. So this is where the money is rotating out, and unfortunately that is the most important part of the S&P 500. That is the large cap growth segment. It's rotating out of favor. So how well will all these other groups be positioned to keep the market afloat? Again, is this getting ready for a crash or a super strong decline? Too early to tell. I don't know. But what I do know is that we're now starting to see a pause, that large cap growth segment stalling. We see technology stalling. And inside the technology sector, we see semiconductor stalling. And that was the narrow, really narrow base that brought us to current levels. Now let me show you how you can get to a deeper insight into the technology sector. So we've got the sector summary panel here, and if you click into the sector summary, you see all the sectors, and then here at the end, the little 4 squares, that's the RRG icon. So go to the technology sector, you hit that RRG icon, and you will get a breakdown of the technology sector into the various industries. And I'm going to bring that to the daily chart because that's what we've been looking at. And here you can see this outlier is the renewable energy equipment. That's a kind of a strange classification. We're working on that in the background to fix all of that. But here is the, let's say, the real technology breakdown. And what you see is that this is semiconductors. And they were leading that group for a long time. Fit this. So they were leading that group for a long time, where semis were actually the ones that are, you know, at high RS ratio levels moving to the right, while all the others were rotating out. And then here you see how semis were rolling over and they're now going into the weakening quadrant. But you also see this is computer hardware. This is the technology sector itself starting to roll over. So basically within technology, what you see is that computer hardware and semis are losing their leading position, and that's going to predominantly, I'm going to say, the software group. So the Dow Jones US Software Index. That's probably one of the most, if you really want to have exposure inside the technology sector, that is really probably the group to look at. Maybe even electronic equipment. That's the DJUSAI here. and you got the CT, that's telecommunications equipment. This one is already rolling over. That computer services index has just stalled there today. So within technology, software, communications equipment, and electronic equipment are the groups that are probably taking over from semis and computer hardware. And by the way, this XLK tail here helps you to basically, I call this a double benchmark index or a double benchmark RRG, where we have the S&P 500 right here. You can see the entire sector here with XLK, and then you can see all the industries rotating around XLK. So you could draw an imaginary crosshair around XLK, so XLK is the middle, and you would have the positions of all these groups on when you would bring that. Let me. Why don't I do that? Just do XLK right here, and you'll see what I mean. So now you see. Let's take this out. You see how this is now all varies against XLK as the benchmark. And I hope that you agree with me, or you can sort of virtually imagine that when you have the S&P here, everything kind of shifts to the top right. That's what I wanted to share with you today. As I said, large cap growth starting to roll out, money moving to the other segments of the market. We'll see the same in the sectors, money starting to rotate out of the technology sector. Pretty big disconnect on both the daily and the intraday charts of technology versus all other sectors. And the real question is whether whether there will be enough money left in the market to keep the S&P and the Dow Jones US index at current levels. Because mind you, when people are selling technology, they have either the choice to move it to other sectors, so real sector rotation, which would keep the market at current levels because it's not taken out of the market, or when they sell their technology holdings, bring it into cash or move it to other asset classes. And if that happens, then we will see more pressure on the S&P 500. Hopefully this week will give us a little bit more insight and information on that type of rotation. And we're going to talk about that next week. So I'm looking forward to seeing you again next week, same time, same place.